Welcome. In this lecture, we will talk about the last lecture of economics, which talks about open economy, macroeconomics. So to begin with, the very first thing is, what is this open economy? Open economy is where you are interacting with other nations. When I say interacting with other nations, it would involve goods, it would involve services, and it will involve financial aspects. So two things, the output market and the financial market are the basis for the open economy operations to occur. Under the output market, we say the economy can trade goods as well as services, and this would form the structure for the basic macroeconomic framework where the consumers and the producers can choose between either the domestic product or the foreign capital products. The next is financial market. Financial market says how much financial assets are there from other countries. So it focuses on the financial assets and talks about the opportunity that an investor has to invest between the domestic and the foreign assets. The next is labor market. Labor market is where we choose to locate the production services and the workers choose to work. So labor market is the third aspect of an open economic proposition. So labor is free to either migrate. They don't have barriers. They can migrate out of the country. They can migrate into a country, and they would find whether the production is feasible, and they would locate, or they would choose their own choice where they want to locate themselves. The next is foreign trade. Now, whenever India's aggregate demand comes into play, foreign trade has a crucial role. Why do I say so? There are two important aspects of it. One is leakage, the other is ingestion. When I say leakage, what happens? When an Indian person buys any foreign commodity, what would happen? The Indian person is buying the foreign good, so money is moving out of the India, out of country. When the money goes out of country, we call it as leakage out from the circular flow of income. And since there is leakage, it would decrease the aggregate demand. On the other hand, when the foreign company is willing to invest in India, there would be inflow of the money. When there would be inflow of the money, it would lead to increase in aggregate demand of goods and supply. So foreign trade actually affects the aggregate demand in the country, and how does it do so has been explained here. The next is, we use money as a means of exchange. So when I say I am trading with, let's say, United States, I would use rupee versus dollar, but we don't have a common single currency at play. Now, currency is simply a medium of exchange, as we had studied in our prior lectures. So when I say it is a medium of exchange, how much credible it is important to understand. So this aspect of credibility, how credible the money is, how credible a dollar is, how credible a euro is, a pound is, or a rupee is based on two things. The first is the price at which the conversion takes place. So for example, if I say $1 says so many X currencies, right? That means if it is 10,000, this currency which is X, which has a conversion of 10,000, has a very low price of conversion, and therefore the credibility is low. So if the country wants to get loan, it would have a difficult time. The next is the ability to convert freely in unlimited amount. So if that currency wants to convert itself free in the unlimited amount, how much it can do so, that's again decided by the credibility. The next important thing is foreign exchange. What do we mean by foreign exchange? That means how much rupee could be actually kept in $1. So if I say, let's say 50 rupees makes $1. Okay, that's the foreign exchange. That means if I have 200 rupees, I can get $4 against it, right? And that explains the foreign exchange rate. It also is known as simply the exchange rate. So I call it as a foreign exchange rate or the exchange rate, and this is the basis where we know how much cost I would be paying if I need a service from, let's say, America. I need a service which is $4. From India, I would be paying $200 for the same if the conversion is rupees 50 to $1. Now, another important thing is balance of payment. If my receipts equal to my expenditure, in that case, the balance of payment is what? The balance of payment is 0. If my receipts are greater than expenditure, then it is a surplus. If my receipts are less than the expenditure, then we say there is a deficit that exists. Now, this balance of payment can be truly understood into two: current account and capital account. However, the new classification says that there are three ones: current, capital, and financial. Even the IMF, the 6th edition of IMF and International Investment Position Model, which is BPM6, say that these three are the basic ideas through which it would be laid down. RBI has not made any changes in publication of the data. RBI still publishes the data in two heads, which is the current account and the capital account. However, the new system has been laid down and has been mentioned under the Balance of Payment Manual for India, published in 2010. But still, the data which is published officially is based only on the classification of current account and capital account. So what is current account? Current account is the record of goods and services and the transfer of payments. So we classify it into goods, services and transfer of payments. Goods would include export and import. Services would include net factor income and net non-factor income. So net factor income would talk about the compensations, the investment incomes. Non-factor income would say insurance, software, banking, tourism, shipping would all be non-factor incomes. Transfer payments are really interesting. Transfer payments are the receipts which the residents of a country gets for goods and services without gets for free, right? Without providing any goods and services. So there is no goods and services which is provided, but these transfer payments are obtained by free. So let's say I have a family here. One of my family members is based in Dubai. That person earns in Dubai and sends the money here to my family. Then this is a transfer payment. It could be in the form of gift, remittance or grant. And that person would say that I am sending this money to the country and that's so that I can run my family down here. So these transfer payments are made for free. Right? They are not against any goods and services. In lieu, I am not sending any goods and services there back, but they are just providing it to me for free. They could be done by government, they could be done by private organizations, but yes, this is what is transfer of payments. Now, under the current account, I can see under the balance of payment, I can say there are two elements: balance of trade and balance of invisibles. What is the difference? Balance of trade would include the value of exports minus imports. So if my exports are greater than imports, I would have a surplus balance of trade. Note what is the difference between balance of payment and balance of trade. First of all, balance of trade is a subset of balance of payment. Under balance of payment, we would talk about revenue and expenditure. Under balance of trade, I would talk about exports and imports, right? So if exports are more than imports, it is surplus. If exports are less than imports, it is deficit. So net invisible. The next is balance of invisibles. What is invisible? Invisible is the difference of the goods and services which the values of exports and imports which are invisible for the country. So this would include what? This would not include goods. So balance of trade would include goods because that's visible. Balance of invisible would include services, would include transfer payments which are not actually visible items that you can see. And these services actually include both net factor income and net non-factor income. Net factor income comes from factors of production, as we have seen, land, labor, capital. However, non-factor income comes from other services products which are shipping, banking, tourism and so on. Clear? So balance of payment can be further classified into balance of trade and balance of invisible. The next is capital account. Capital account can be divided into two segments. One is the investment And the second is external assistance. So an asset which a company purchases in form of wealth, it could be money, it could be stock, it could be bonds, would all fall under capital accounting. So under external, I can simply get a assistance that could be government aid, loans, governmental projects that are coming in. So it's just an assistance, a help that is being provided by an external agency. The next is external borrowing. This would include external commercial borrowings, ECBs, or short-term debts where I take loan from the other party. Then is the investment which is brought into the country. So investments could be direct or portfolio based investments. When I say direct investment, it would be foreign direct investment. It would be direct capital flow. Portfolio investments would include FII, which is foreign institutional investments, and they would also include the offshore funding. Now, the purchase of asset in is what? When I am purchasing an asset, let's say India purchases asset from UK company. So we call this as a debit item on the capital account. So if India buys something from UK company, it would be a debit item. On the other hand, if I am talking about sale of asset, that sale of asset would go as a credit. So let's say India is supplying something to people in Europe or China, then it would be the sale of asset and this would go into the credit item. So understand what is debit item and credit item under capital accounting. So as we said, the balance of payment could be broadly classified under capital accounting and current accounting. Both of those are the standard old methods which are still taken into consideration by RBI. The next is balance of payment. As I said, the sum of the current as well as the capital would turn out to be 0. That means what happens if, let's say, I am running short of money, I would either sell some of the things that I have or I would borrow something from the others. The same happens for a country at a larger picture. So if country is running through deficit, what would country do? Either country would sell the assets, that's one way of earning, or the country would actually borrow from abroad. So the present case of Sri Lanka, where there has been extensive borrowing, is the way to explain that the country is suffering from deficit, right? Now, when my balance of payment is in equilibrium, that means my revenue and expenditure are equal. That means there is no debt which is being financed, right? Or I can say the debt is being financed entirely by the international organizations without any reserve. Now, what is reserve? Reserve is an official term when RBI sells the things that the RBI has. So RBI sells what? RBI would sell its foreign exchange. RBI has the foreign exchange and RBI would sell what? RBI would sell the foreign exchange because it has its foreign exchange, and RBI would sell that foreign exchange, and this would be known as the official reserve sale, which says that yes, the country is running in a deficit, the country needs some kind of money, some kind of assistance. So whatever foreign exchange we have, we are ready to sell it off, and this is under the official reserve sale. Now, if there is a decrease in the official reserve sale, it would lead to deficit. If my official reserve increases, that means the surplus of the country is increasing. Clear? So that's another important aspect. Now, under the same thing, we talk about two types of transactions: autonomous transactions and accommodating transactions. Autonomous transactions are the transactions that are done for a reason other than bridging the gap for the balance of payment. So my idea is not to narrow down the balance of payment, but my idea is profit motive. And for that, if I am doing any transaction, I call it as a autonomous transaction. On the other hand, so if this transaction is in surplus, that means I am having my receipts greater than the expenditure. If there is a deficit, my receipts are less than the expenditure. So this is autonomous. What is accommodating? So autonomous is actually above the lines, as it is called as. Okay. The next one is accommodating. We call it as below the line. And this explains the gap in the balance of payment. And this could be the deficit or the surplus in the balance of payment. So when we talk about the errors and the omissions under the balance of payment, when there is an overall balance, we say it is 0. But when there is a deficit, my overall balance reduces, but my reserve change increases because official reserve sale increases. However, when there is a surplus, my overall balance is more than zero. That's positive because my revenue is more than expenditure, but at the same time, my reserve is reduced. Reserve change is actually reduced, and that's based on the current and the capital account. To make it very clear, when my revenue is less than the expenditure, I would have a deficit. When my revenue is greater than the expenditure, I would have a surplus. And when my revenue equals to expenditure, I would have a balance of payment. Clear? The next is another important concept which we call as foreign exchange market. Now, what is foreign exchange market? I need to buy a commodity for $1 from United States. If the conversion rate is 50 rupees per $1, that means as a citizen from here, I would have to pay 50 rupees in order to get that $1 product. And this is what is known as exchange rate. Now, this exchange rate keeps on changing. There could be floating exchange rate, fixed exchange rates, and flexible exchange rate, which we would understand in the next section. But the idea is there are two components that we understand. One is demand for foreign exchange. The next is supply for foreign exchange. When would the demand of foreign exchange increase? The demand of foreign exchange would increase when I want to buy some products from other countries. I want to send gifts to other countries, or I want to purchase a financial asset in another country. But whatever I am doing is for other country. In that case, the demand for foreign exchange would reduce. So what would happen? The price for the foreign exchange would increase, and as the price for the foreign exchange would increase because people are more willing to buy products in United States, so the rate of foreign exchange would increase, the rate of rupee would depreciate. So my rupee would turn out to be, let's say, 70, because people are moving their money out from India, pouring it into United States. So my foreign exchange would increase, but this would have an repercussion on the country. That means the imports would fall down. Since the import would get costly, the imports would fall. Clear? What would happen on the supply side? Supply side means I am supplying things from here. That means the purchase for the domestic products in the international market would increase. There would be more gifts which would be sent to the country, gifts coming in the country, right? I would mention it as in the country, and more people investing in India. Now, when more people are investing in India, this rupee rate would go down. The rupee would become costlier. It would appreciate. So, it would get to 30 rupees, for example, for $1. That means I can now get cheaper goods from abroad. So, my imports in this case would start to increase, right? Why? Because the exchange rate gets lower and I can get cheaper products from United States now as compared to the previous scenario. So my imports in this case would boom up and my exports would actually be dependent on the elasticity of the demand for exports and imports, right, ultimately. But this is the basic picture that we need to understand under demand and supply. The next is, how do you determine the exchange rate? As I said, exchange rate, the first is flexible exchange rate that we would understand. Flexible exchange rate means the exchange rate is not fixed. It would keep on changing. Even the RBI or the central bank would not control it. So what happens is, this is dollar and this is rupees per dollar. So we call it as exchange rate. Now this is the demand and the supply. Now the point where they intersect would be the exchange rate. Let me mark it as E star. Now what would happen? As soon as my demand increases, I would have a new curve that would be for the demand here. And this new curve would have a new exchange rate E1, which would be explained. And with this E1, I would have the new rate for the dollar as well. So we understand that this flexible exchange rate system is important and the price is determined based on the exchange rate that we are trying to say here. So what we say here is, as the demand increases, the price of the dollar in terms of the rupee has increased and therefore depreciation of the currency takes place. So when there is increase in the exchange rate, I would say currency starts to depreciate. In the next case is appreciation of the currency. When I say appreciation of the currency would happen, what would it imply? The price of rupees in terms of dollars would increase, right? So price of rupees in terms of dollars would increase. That means 30 rupees to $1. Here when it depreciates, I would say it would be 70 rupees to $1, as I already explained in the demand and the supply section, right? Here we already did it. How we saw the fluctuations would occur here. The same thing has been explained in determination of exchange rate. So appreciation and depreciation of the currency would take place. And another important thing that we must keep into mind is speculation. What is speculation? I feel that a lot of people are flowing their money out of India. Now when I am speculating that means that the rate of the dollar is set to rise or the rupee is set to depreciate. So probably right now the rate of rupee is 80. I am speculating that lot of investments are going out of India. So this rate would go down to rupees 85. The rupee would depreciate. Now this is what I am speculating. But at the same time, if I speculate, let's say the country is doing well and there is lot of inflow of the capital. Now this $1 against $1, I could get rupees 70. Okay, so that means the country is performing well and a lot of money is coming in. So the expectation is if the current exchange rate is 80 and if it increases by the end of the month to 85, that means I am able to make a profit. If I purchased it for 80 and now it is 85, I can make a profit of 5 per exchanged rupee. So if I have taken into account, let's say $100 with me, I spend in 80 into 100, but at 1 month back, but now the rate is 85, so I am getting 85 into 100. So now I get 8,500 and I spend 8,000. So 1 month back, the $100 that I purchased, I would sell it now, and when I would sell it, I would get 8,500. That means I generate a profit of 500 rupees here. So this is what is speculation in the market. So the expectation whether the currency would drop or the currency would appreciate actually is explaining this whole cycle of exchange rate. So how exchange rates are determined is an important topic. In the next section, we would also understand the floating and the fixed exchange rates.